So without further ado, let me start by introducing and welcoming everybody to the Business Acceleration webinar series. This is presented, I am the host, my name is JG, and I'm the author of Messy Manager. I'm just going to take a quick second and introduce myself, and I'm going to introduce my co-host, who's Rob Herman, in just a minute. But myself, just a little bit about me. We have people on the line here from all over the Toronto area, everywhere all over the greater Toronto area, north, south. We actually have people from Europe because I have a following in Europe, and I sent this out to my list, and we have people from Malaysia and Australia on the line as well. So I want to welcome everybody from all around the world. It's going to be an exciting event tonight with the Business Acceleration webinar series. This is part 1, and Rob and I are going to tell you a little bit about what's coming up in part 2, 3, 4, and 5. But this is part 1 with Ross Libbey. And myself, my name is JG. I'm the author of this book, Messy Manager. I've written 4 books. The last one is Messy Manager. And essentially, over the last decade, I've owned, built, sold, managed, and consulted companies in 25 different industries. My first company, which was a health and wellness company, went from 300 to 3,000 clients in 6 months. And then I went on to build and sell a variety of other companies, and now I have interests in companies all over the world. And I work with experts like Ross and Rob to bring this great information to all of you small business owners on the line. A little bit about my co-host here, who's on the line with me today, is Rob Herman. Now, Rob is an expert marketer in the field of online business generation. Now, you know, everybody knows Google, SEO, all these PPC, PPV, all these acronyms and technicalities. Rob is an expert in this, and he actually wrote a book that is phenomenal. I love it, and I highly recommend it to everyone. Actually, I'm going to tell Rob to send a copy of his book to everybody on this webinar because it is that good, and it's called Robert Herman's Guide to Marketing Your Business Online in Toronto. Get ranked, get found, and best of all, get customers. Rob, are you with me?
Hey, Jean-Guy. Yeah, I'm here. Thanks for that great intro.
No problem. Hey, the mute button is the little green one there. So, Rob, we're in for a great series here, obviously. It's going to be a phenomenal event. Why are you so excited about this event and what Ross Libbey has to say today?
Well, you know, a lot of small business owners, they come in and they start their business. They have a fantastic idea, but they don't necessarily know how to make the best bang for their buck, how to get things from the government, how to keep the government out of their pockets, how to position themselves to really benefit the most from the money and the revenue and the cash streams that they have. And that's why this is the first part of our webinar series, because Ross is an expert in this, in helping small businesses, and he's going to show all the people that we have on the line here how to get the best bang for their buck.
That's fantastic, and you're absolutely right, Rob, and I want to take just a second and introduce Ross in 1 minute, but before that, I want everybody to know this is a webinar series, which means next week at the same time, you have your registration all ready for it in your inbox. We're going to be featuring international best-selling author Jerry Robert, who's actually a business partner of mine, and without a doubt is going to absolutely amaze you with his attraction marketing strategies and everything he's brought to the business world. He's spoken to and addressed over 3 million people in the last 25 years, and he's generated in excess of $100 million in revenue. So he's definitely got a powerful message to show people how to build their business and how to take their companies to the next level. We're also going to be featuring Rob. You're going to be one of the featured experts the week after that, and I'm really excited about your presentation because you're going to be talking to business owners about how they can take advantage of online marketing, internet marketing, and all of this new stuff, which is so confusing. It's giving people a headache, but you have a way of simplifying it and making it easy to understand and easy to implement, and you have phenomenal solutions. So, Rob, I'm really excited for your presentation in a couple weeks.
Thanks so much, JG. Me too. And if you stick around, if you're enjoying what we're going to be giving you over the next 4 weeks, with Jerry Roberts, millionaire mindset, best-selling author. We have Ross tonight. We have myself. I'm going to show you some tricks and tips about how to get more traffic to your business. And if you wait, we keep the pièce de résistance for Jean-Guy. who's going to be showing you some just phenomenal, it seems so simple when he puts it down, marketing directions, but once you implement it, it's just so powerful. So let's get into that. I'm loving it.
All right, excellent. Well, let's get introducing Ross. So I want everybody to understand. Many people on the line may know him, definitely may have heard of Ross Libbey. He's an expert accountant, entrepreneurial guru in the field. So I just love it because Ross, what I like best about Ross is that he's not a typical accountant. And this is something that I pride myself in saying because Ross is going to give a powerful presentation tonight. We got people from all around the world on the line. And not only has he worked with big, large corporations, he's worked for them as a vice president, as a controller. He's worked in finance administration, but he has his own training and consulting company now, Your Bottom Line, which has impacted a lot of hundreds and hundreds of companies in the GTA. And this guy really does make a difference in people's lives. So without further ado, let me introduce you, Ross Libbey. Ross, are you there?
I sure am. Can you hear me?
I can. We can hear you just fine, my friend. I want to thank you for being here, Ross. Everybody is the lines are jam-packed. I don't think anybody can get in even if they wanted to. A lot of people think that a webcast is unlimited and we can host as many people as possible. That's actually not the case at all. We do have a max number, and we are very close to maxing out. So congratulations, Ross. I'll let you take it away.
Great. Thanks very much, JG. And Rob, I hope I can live up to the billing. Well, my idea here today is to talk to you about how you can increase your bottom line, and this is part one. You know, we're here to talk today about what are the different things you can do to increase your bottom line, and there's a variety of different things that anybody and any business can do. You can sell to more clients. You can sell more to the existing clients that you've got. You can always increase your selling price, although there's going to be limits to that. And you can, alternatively, you can decrease your costs and expenses, and you can decrease taxes. And that's going to be my primary focus today. And we will be coming back, hopefully, and I'll have another chance to talk a little bit more later about decreasing the other costs and expenses of your business and some of the other things that you can do in your business. Now, I'm very conscious of the fact that we do have people here not just from Canada, so I do need to point out my big fat caveat here. Every business owner's situation is different, and what we have here is going to apply on a very generic kind of basis. You need to talk to your own tax advisor to make sure that what you're going to do in your situation is appropriate for your circumstance, especially if you're outside Canada. A lot of what I'm talking about will be very generic, and if it's Canadian specific, then I'll make sure to let you know. I want to start here and talk about how statistics can actually save you dollars. What exactly am I talking about here? Well, let me tell you this. The average small business owner loses anywhere from 10 to almost 35% of their otherwise deductible expenses. Why do you think that might be? Well, it's very simple. It's because they don't keep track. It's not that anything is that difficult. It's not that it's impossible to keep all of that information together. It's just that they don't take the time to do it, and they don't do it in an organized fashion so that they can use it on an ongoing basis and make it work for them. Okay? So my idea here is, how can I help you do this? How can I help you keep better track of what it is that you've got? Okay, now, how is it that taxes affect your cash flow? Well, if you can save taxes, you can enhance your cash flow and your after-tax profits. So, of course, you want to make absolutely sure that you claim everything that you're legally entitled to. I can't tell you how many times I've had clients who've come to me saying, well, you know, I've got this expense in my business, but geez, I'm not sure if I want to claim that. I don't want to attract attention. Well, if you have the support for it and you know that it's a legitimate expense of your business, why shouldn't you claim that expense? I had one client who was a photographer who did quite a large amount of travel and did a lot of photography on spec. And he never claimed, and prior to being my accountant, never claimed any of these trips. And this was a significant amount of money. And of course, you know, now we're claiming everything that he is legally entitled to. So the starting point here is anything that you have spent money on in order to generate income from your business should in fact be deductible. Now the operative word here is should. There are certain limited circumstances where that may not necessarily apply, but for the most part, anything you're spending on your business should be deductible. Okay? So, that having been said, let's talk. What I'm going to talk about now is a few of the very common issues. Okay, not necessarily in order of importance, but these are the ones that I notice that people have challenges with the most. Normally, one that I leave to the back end is the home office. There's a variety of different reasons for it. There's a lot of reasons why people have challenges with it, and I want to start with, and this is the Canadian situation, you cannot claim a home office to increase a loss. You can only claim it against income, or you can carry it forward. So because you can carry it forward, you then want to make sure that you calculate it every year so that if you don't use it this year, you can claim it next year. And I've had clients who had situations where they've had little or no income for, say, as many as 4 or 5 years, and then in the 5th year it balloons. They make a lot of money in the 4th or 5th year, but what happens then is they can now claim all of those home office expenses that they've carried forward. Now, how is it that you determine your percentage? Well, you can use square footage, or you can use the number of rooms. A quick little tip for you is that usually the number of rooms in your home, and again, don't count bathrooms, don't count hallways. Usually the number of rooms in your home will play to your best advantage, but you can look at whether it's square footage, whether it's 1 room out of 8, and you can determine which works best for you. What are home office expenses? Well, things like your utilities, your rent, your utilities being your gas, your electric, your water. Outside of utilities, then we get into things like insurance, your repairs and maintenance. The reason I put note here is that I want people to know that if you're doing a repair specifically on your office, you want to claim that as office repairs as opposed to home office repairs. So in the example of somebody who is using 1/8 of their home, 1 room out of 8 rooms, if they were painting the entire house, they would get to claim 1/8 of all of that. But if they were painting their office, they'd claim it 100%. So big difference there. Okay, if you have a home that you own, you can claim your mortgage interest, and if you don't, if you're renting, then you can claim your rent. And of course, if you own it, you can also claim your property taxes. Now, what you're going to do is you're going to, assuming you're using an accountant or a tax preparer to pull this all together for you, then what you're going to do is give them the 100% number, give them the percentage to utilize, either 10% or 1/8 of my home, whatever it might happen to be, and let them do the calculations from there. Don't give them the numbers having already applied the percentage to it. Otherwise, you're going to end up losing some stuff. Okay? There are certain other things. One of the things that comes to mind from time to time is if somebody pays for security for your home. You can also claim that, and there are certain other limited ones, but I'm not going to go into too many other details. Okay? Automobile expenses. This is another one that is really a big bugaboo for a lot of people. And again, whether you're in Canada or any other country, let me tell you the first issue. The number one question I get from people is, how do I deal with the percentage of my automobile that I can claim? Now, it's easy if you have a car that you drive solely for business. Well, it's 100%. Be very careful about that. You still need to maintain a log that verifies that you use that 100% for business. I had a client many, many moons ago who used to have the best logs I'd ever seen, and he started doing his returns on his own, and he got married, and he determined that, hey, all of a sudden now we have one car that I'm going to use solely for business, and we have another car that I'm going to use for all our personal stuff. So he stopped maintaining those beautiful logs. Well, 3 years later, Revenue Canada, CRA, came back to him and said, we'd like to see your mileage logs. And he said, well, I don't need one anymore. And they said, oh, really? Tell us about that. And after he explained what he had done, they said, well, that's all well and good, but we'd like you to prove that you used that vehicle 100% for business. And of course, 3 years after the fact, he was able to reconstruct his log, but not as perfectly as he would have been originally. And he ended up losing some of the expenses that would have otherwise been claimable. And it cost him quite a bit of money. So maintain a log. It doesn't have to be rocket science. Make sure that you're tracking what miles you're doing for business and comparing that to what you're doing in total. Okay? What are your automobile expenses? For the most part, again, this isn't rocket science. It's the fuel and oil. It's your interest and your capital cost allowance, or what most accountants call depreciation, right? Or maybe you're not, maybe you don't own the vehicle, maybe you're leasing it. Okay? Additionally, your license and registration. Here in Ontario, it's only $74 a year, but don't forget to claim it. Okay? The maintenance and repairs on your vehicle. You can claim your portion of that. There are certain other limited costs that you might have as well. In addition to which, you've got things like any business parking you've got and any supplemental business insurance. Now, I want to clarify here. Everything down to the spot where I've said other on this slide is all deductible to the terms of the percentage that you have used your business for vehicle. So you've used your vehicle for business. If you've used it, for the sake of argument, 74.5%, then what your accountant is going to do is going to take the total numbers that you provide and apply that 74.5% to those numbers. That does not apply to the business parking and business supplemental and the supplemental business insurance, because in that case, that is 100% deductible. So you don't want to lose that. And again, just like with home office expenses, make sure that you provide the numbers in total along with the percentage, and so that your accountant can deduct those appropriately. Okay. Next one I want to talk about. Everybody always asks me about meals and entertainment. Now, the rule in Canada is that you cannot claim it all. You can only claim 50% of your meals and entertainment. And Revenue Canada's logic here, CRA's logic, is that, hey, you have to eat, so we're only going to let you claim 50%. Now, you do want to track it 100%. You do need to make sure that you're providing complete information. However, again, your accountant will apply the appropriate percentage to it. Okay? Now, if you do have certain special events going on, like, for example, you've got a Christmas party, you can deduct 100% of those kinds of special events, and you can do that for up to 6 events in a year. And now, do yourself a favor. Make sure if you're going to claim 100% of anything, like, for example, the Christmas party or any other a summer party, anything that you might have like that, make sure that you keep your receipts and your documentation, because you may be called upon by Revenue Canada to prove it. Okay? And if that's the case, you don't want to be having to scramble about it at that point in time. So even an announcement of a Christmas party or a summer barbecue or a client event of some sort. And again, remember, it is limited to 6 per year in Canada. Okay? Now, there's quite a variety of different things that you can do to save taxes and to help yourself out. One of them, in Canada at least, is that you can also employ your spouse or your children, family members. Okay? Note, whatever you pay must be reasonable, and it has to be in line with the services that they perform. Canada pension contributions are not required for youths under the age of 18. EI deductions, you're going to need to discuss those with your tax advisor. Obviously, these are things that apply only in Canada. And additionally, a note I want to make here is that if you've got minors working for you, even if they have no taxable income for the year, they should still file tax returns. The reason for that is this, that they may still be able to develop RRSP eligibility, and so or they may also qualify for certain credits. So you want to make sure that even if on a net basis they're earning less than the taxable thresholds, you want to still file their tax returns. Okay? And also, a quick little side note, subcontracting may also be an option. Now, I'm not going to get into a conversation right now about the differences in Canada or anywhere else between subcontracting and employment. But what you want to note is that if you go the subcontracting route, you need to make sure that your family member who's gone that route is also claiming it on the other side. Okay? So, we're moving right along. A few miscellaneous items I want to talk about. First, a lot of people ask me about the phone. Can I claim my home phone because I use that as a business line? Well, the whole challenge with that is Revenue Canada says that the first line coming into the home is typically a personal line. And you have to respect that, even though in today's world, with the advent of cell phones, a lot of people are now giving up their home lines. And so that is gradually beginning to change, but Revenue Canada has not yet changed their reference to that. By the way, I'm just realizing I'm referring interchangeably to Revenue Canada, which is in fact an old terminology, and CRA, or Canada Revenue Agency. They are one and the same. Okay? If you have two lines into the home, a home phone and a business line, then that makes it very easy. But if you have a personal line coming in that you also use for business, you cannot claim that home line. Now, if you do add certain services to it because of business, what you can do is you can claim those services. Okay, so I have call waiting and I have caller ID and I have those because of my business. You can claim those services. Now, of course, you can claim also your cell phone. For some people, they may claim the cell phone, half the cell phone, because I have it half for business and half for personal. Other people will say, I wouldn't have the cell phone were it not for my business. Depends on you and your circumstance. Your internet, again, same situation. Some people will claim it 50-50, some will claim it all. It depends on your family situation and your business situation. Now, next situation I want to talk about is moving expenses. Now, in Canada, you're going to claim the business portion only of your moving expenses. Because it's only those portions that relate to the business that you're able to claim. If, in fact, you're moving 40 kilometers closer to work, there's another way of claiming those moving expenses outside of the business altogether. So I'm not going to get into that. You need to use a form T1M in order to be able to claim those moving expenses. But if you're moving your business, if you're moving from one place to another, moving your whole business, then you can claim the business portion of those expenses. Okay? Now, if you pay for tax preparation or accounting, or bookkeeping, any sort, or you pay for related softwares, you can also claim those as deductible expenses. Again, I'm not using this as a sales pitch for myself or for any other accountant, but your taxes do get much more complex when you add in a small business. And so do yourself a favor and recognize that it's worth getting the services of an accountant. I don't need the business, but make sure you get an accountant. Okay? And here's the good news, is that is tax deductible. Okay? Also, on the same vein, if you are taking advantage of any professional development, any education, even if you were to have paid for a webinar like this, then that is also tax deductible. Okay, so if you're at for the sake of simple math, if you're at a 50% tax bracket, something that might cost you $700 might, on an after-tax basis, only cost you $350. So you can factor that into your decision making as well, once you know what's deductible. Another situation, and this one is likely specific to Canada, although other countries will have similar rules, you can also use what's called a PHSP here in Canada, Personal Health Services Plan, and I don't want to get into the technicalities of how this one works. This is a little bit more complicated, but what it allows you to do under certain circumstances is you can put your medical expenses through your business and save a lot of tax. In Canada, you can claim either the medical expense credit, which is worth about, let's say, about 15 to 25% of your medical expenses, or you can claim them 100% against your other income. Which would you rather have? The PHSP allows you to claim it against the income within your business. Okay? This next one is very, very simple. Right? If you have clients that have not paid their debts to you and they're over 90 days old, then you want to make sure that you've written off those bad debts, or at least allowed for those bad debts. Maybe you want to still try and collect them. But if you allow for them, you can actually write that off and take that bad debt expense prior to the end of the year. And that will also reduce your net taxable income. Okay. Also, if you have any inventory that you carry for your business, now I know a lot of people on the line are in service-oriented businesses, so this may not be relevant. Okay, but if you do carry inventory, make sure that if any of it has lost value, that you've taken that into account. Okay. Additionally, you really want to do everything you can to avoid interest and penalties. Don't file things late if you can avoid it, especially not to CRA. And the reason I say that is not only are you incurring interest and penalties, but you get a double whammy when you have interest and penalties from Revenue Canada, from CRA, sorry. If you're getting interest and penalties from CRA, those are also not tax deductible. So not only do you have to pay the interest and penalties, it's in after-tax dollars. So my 50% tax bracket analogy doesn't help you out in this one. Now, assuming you have assets in your business, I want to talk about how to manage those assets. You get to depreciate your assets over time. So if somebody buys a $20,000 piece of equipment, from an accounting perspective, we write that off 1 year at a time, and let's just say for the sake of argument you're writing it off 20%. Okay, so you're going to take a $4,000 depreciation, or from a tax perspective we call that capital cost allowance. Now, here's the point. Timing can make a huge difference in your capital cost allowance. If you buy something in December, as an easy example, I had a client who called me up at the beginning of December, said he was thinking about buying a new car for his business. Well, it's the perfect time to buy a new asset, because now you've only had it for 1 month, but you're able to get the capital cost allowance for an entire year. Now in Canada, in the first year, you can only claim half of the capital cost allowance. So he got 6 months worth of capital cost allowance in that year. But the bonus to him is not only did he get 6 months when he only had it for 1, but now in the second year he gets full capital cost allowance in the year when he had full usage of it, rather than having purchased it in January when he would only get 6 months worth on that year. Okay? By the same token, if you look at something from the other perspective, now I have a new car that I've just purchased. I also have an old car that I'm ready to get rid of. Well, wait and sell that old car, unless you're doing a trade-in where they by definition happen at the same time. Delay your disposals until the beginning of the next year. So in that way, you get 1 extra year's capital cost allowance that you can claim on that asset. And again, this doesn't matter whether we're talking about a vehicle or an asset in your business, any other asset in your business, equipment, office furniture, whatever it might happen to be. Okay. Now in Canada, we also have a new temporary computer income tax deduction where you can write it off completely in the first year. So that's another nice plus that we have here right now. And now timing can affect you in a number of different ways. Okay, not only just around your assets. Let's talk also around your income. Okay, you can also consider delaying or deferring income. Now, you have to be very careful here. Remember that revenue has to be recognized when you've earned it. You can't simply earn income in December and then simply claim it in January. But if you're in a position where you know you're in a high income tax bracket this year, you may want to say, you know what, I've got a choice in doing this job, whether I do this in December or I do it in January. And what you can then do is you can push it into January and take it at a time when it's going to affect you much less. And of course, again, if we're looking at somebody with a calendar year here in Canada, okay, what you've got is if you did the work in December, you're going to be paying the taxes on that in by April 30th. If, on the other hand, I did it in January, the taxes won't be paid on that until next April, so a whole year and 4 months away. Okay? On the flip side, is there a reason why a business might actually want to increase its expenses? Well, you may want to not necessarily increase your expenses, but claim those expenses earlier. So in other words, I might want to have a look at a situation where I say, well, I'm going to be going out and buying a whole lot of additional office supplies. I'm going to be buying a new computer. Do I want to purchase that in December, or do I want to purchase that in January? Or maybe I'd be buying it in April. Well, you know what? If you were to purchase it in December, it's an expense of the current year as opposed to the next year. Okay? So maybe you do actually want to not necessarily increase your expenses, but incur those expenses earlier. Okay? And that can affect your taxes. Right? Now, I want to talk a little bit here about CRA, Canada Revenue Agency, and alphabet soup. I already mentioned PHSPs. That's the Personal Health Services Plans. We also have here in Canada RRSPs, Registered Retirement Savings Plans, TFSAs, or Tax-Free Savings Accounts. Whoops, go back there one more. Okay, these are mechanisms that Canada Revenue Agency uses to basically compensate us for, give us the position where we can now earn income either on a tax-free basis through a TFSA or on a tax-deferred basis through an RRSP. Now, don't make the mistake of misunderstanding. Any money that's in an RRSP will sooner or later be taxed, but it will be taxed when you retire and start pulling some of that income out. Although it is possible to pull it out before you retire, the idea is that you'll pull that out when you're in a lower tax bracket. Now, if you're not in a lower tax bracket, you'll be taxed at the same rate you are now. Again, assuming the tax brackets stay essentially the same. Okay? Now, what about the possibility that you might have actually lost money? Oh my goodness, does that ever happen to anybody in a business? Of course it does, especially in the first couple of years in a new business. Now, if you lost money, in Canada, self-employment losses can be carried back 3 years and can also be used to offset other income. So, if you had income from employment, perhaps you were employed at the beginning of the year, or your small business is something you do on the side and you have employment income as well. The first thing you're going to do is you're going to claim that loss, that self-employment loss, against your income from this year. But what if you've got a large enough loss that you actually have more losses than other income you have this year? You can actually go back into the previous 3 years and get back some of the tax money that you paid in a prior year. Okay? Now, what if you had no other income? Okay? Carry it back to any of those 3 prior taxation years and you're still good to go. You're still going to be ahead of the game. So, I've taken us through a whole lot of different things. Just a quick synopsis that I want to hit here. Okay? Number 1, make absolutely sure that you keep track of all your expenses and claim everything. I would much sooner, I say this to my clients time and time again, I would much sooner you bring something to me that I'm not going to be able to claim, and I'll let you know that. I'll tell you that. And you know, sorry, in Canada, you can't claim your dry cleaning of your business suits. Revenue Canada does not like that. Okay? But I would rather you bring it to me and we can discuss it rather than not bring me something which I might have said to you, hey, of course you could claim that. Right? And that happens all the time. Okay? The home office, do not be shy about claiming your home office. If you have an office that you run from your home, now again, remember also this must be a dedicated area for your office. If you do your work off the kitchen table, Revenue Canada isn't going to let you claim your kitchen because you use that for personal purposes as well. But if you have a dedicated area of your home where you have your office computer, you meet clients, or you do all your telephone work, etc., and that is used solely for business, then you have a very legitimate claim, and don't be shy about claiming that expense. And if you've got a business loss, don't forget to claim it anyway, because you can then, even though we can't, we want to calculate it anyway and then carry it forward to the subsequent year. Automobile expenses. The most important thing here is to keep that mileage log. Everybody knows what all your automobile expenses are, and we all incur those each and every day and each and every year. But the most important thing that the tax agency wants is they want to know what's the percentage that you drove for business. So a good log says, okay, here's how much what mileage I had when I started the year. Here's the mileage I had as I finished the year. That's the total that I did for the total mileage that I did for the year is simply by subtracting one over the other. And then you take your mileage log and it says, okay, you drove 20,142 kilometers in the year as compared to 30,176 that you did in total on the vehicle, and that comes up to 67% or whatever the magic number is. Makes it nice and easy for Revenue Canada to see when you keep an accurate log. Okay? Meals and entertainment. Don't get too aggressive here, but don't be shy. If you have a meal that you did for business, you discussed business, you were talking with a client, you were working with a supplier, you took your staff out to lunch, whatever the case might be, right? Put it in, claim it, okay? Now, if it's just you, Revenue Canada doesn't like when you go to a fast food joint and just have a burger and claim your own meal. Well, no, that doesn't. Revenue Canada doesn't care that you had a burger. The point is that it's one person, just you. They said that's not really deductible. But as long as there's 2 people or more, you can claim 50% of that expense. You can also employ family members as long as you do it reasonably. Claim the right amount, right? Claim a reasonable amount. Make sure that it's for work that's actually done. Okay, you don't want to be trying to claim that you paid somebody and when in fact they didn't in fact do any work. Okay, I talked about a whole lot of miscellaneous different things, and if there was anything there that tweaked anybody's curiosity, by all means you can ask some questions when we're done here at the end of the presentation. I'd be happy to help on any of those. Okay, as we come to the tail end here, I want to wrap up at my end with a little bit of an epilogue. Okay, I talked earlier about 5 different ways that you can increase your bottom line. I talked about selling to more clients, selling more to existing clients, increasing your selling price, decreasing costs and expenses, and last but not least, the focus today of decreasing taxes. Okay, now don't forget, when you're in the middle of all of this, it's very, very easy to forget about your ongoing marketing while you're in the middle of getting the job done. Getting the job done, I'm hoping that I'm going to get a chance to come back and talk a little bit later about the operational side. And there we'll talk about how to decrease your costs and expenses. And I know that Rob and JG and Jerry are going to be talking an awful lot about the first 3 components, on my list of 5 ways. But don't forget, you've always got to keep marketing. And otherwise, if you're in the middle of one job and that job finishes and you're not doing the ongoing marketing, then all the rest of this is for naught, because then your funnel dries out. Okay? So always remember, when you're up to your neck in alligators, it's difficult to remember that your original objective was to drain the swamp. Don't forget that you've got other things that need to be done at the same time. And that's it. JG, I'm back to you.
Thanks, Ross. That was really great. I mean, that's what I told everybody. I promised that everybody would get actionable items that they can take to their business that would make a difference in their bottom line. That's exactly what you delivered. So thanks a lot for that. I appreciate it. Now, Michael had a question, and if anybody has questions, I can't unmute the lines because there's too many people, and as a result, it's going to create a massive echo. And you can only unmute the lines if you have just a sort of a few people, 10 or 15, but we have way too many, so it's not going to work. But there is a chat box there. It says chat, and you can put in a question there, and I'll ask Ross the questions. We'll take a few minutes for questions, and then I'll sort of wrap things up. Because Ross does have an incredible $299 consultation that he offers for free for the people who've listened to this, and that is available to you, and I want to show you that in a second. But before I go there, Ross, Michael asks, what about software leasing versus purchasing? I think he's asking, should I lease it or should I purchase it?
Well, that's a really good question, and again, it's one that isn't, a lot of people think that there's one very simple, straightforward answer to that, and it's never as straightforward as one might like it to be. The first thing that I can say, and I also spent 7.5 years in the leasing industry, so I'm very used to this question, but here's the situation. Leasing is essentially another form of financing. And so the first thing I'm going to say to anybody is you want to make the best financing decision. Typically, taxes is only one small part of that decision, and everybody's situation is going to be very unique. I get a lot of people who ask me, should I lease this or should I purchase it? And I've heard that leasing makes things so much simpler. Well, it does make it simpler if you're the person doing the taxes, because if you're leasing, whether we're talking software or a vehicle, you're leasing it for $500. All you do is put that $500 through each and every month, nice and simple. However, if you purchase it, then you've got to calculate capital cost allowance, and you've got to calculate what's the interest expense every year. Well, you know what? Are you the one who's going to end up doing that? No, it's not you. It's going to be your accountant who does that. So don't worry about it. It's not harder for you. It's going to be an extra calculation or two for your accountant that most accountants could do in their sleep. So don't worry about what's easier. Okay? Look at the financial decision first and foremost and answer those questions first. Okay? So an easy example somebody gave me the other day is, well, leasing gives me a 5% interest rate, but right now they have a 0% purchase rate. Well, that's probably going to be a big part of your decision. So look at all different factors in it and take it to your accountant, because every situation is going to be a little bit different. Sorry, I couldn't give you a clear-cut answer on that one, Michael.
Well, that's exactly what the consultation is all about, Michael. So I'll encourage you in a minute just to go get that consultation from Ross, and he can answer specific questions. Ross, another question from Marino here. He says, Ross, I don't know that I heard this correctly. Did you say that business losses can be carried back 3 years to be deductible from employment income received that long ago?
That is absolutely true, Marino. You can claim not only against this year's income, but if you wipe out this year's income, let's say somebody made $10,000 in employment income and they had a $15,000 loss in the first year of their business. They can wipe out this year's $10,000 income and they can take the remaining $5,000 back either 1 year, 2 year, or 3 years, depending upon their circumstance, and claim that against income in a prior year. So yes, you did hear that right.
That's fantastic. That's great. So, okay, what I'll do is I'm just going to wrap this up, everyone. Ross, would you flip over to that website for me? I just sent a message to everyone. I want everybody to go to this website. It's smallbusinessaccountantsdurham.com, and this is Ross's new website. On there, you're going to see on the right-hand side, there's an opportunity for you to get a free $299 cash flow consultation. Now, it's limited to 3 per week, and the reason for that is, I mean, obviously there's a lot of people on this line, and Ross can only do, some poor guy can only do so many free consultations. He has several hundred clients that he has to help as well, so it is limited to 3 per week. So what I recommend is hurry up, go there. Once you fill in the information, Ross is going to get in touch with you and schedule that consultation. So I'd encourage everybody, take advantage of this. Whether it's Ross, and if you have your own account now, I'd encourage people to get a second opinion. I've recently switched from my own accountant to Ross because some of the advice Ross was giving me turned out to boost my bottom line. Guess what about that, eh, Ross? Isn't that amazing?
I love it when that happens.
So I encourage everyone. Let me end it with that. Ross, first of all, I want to thank you. You did a phenomenal job tonight. I know everybody appreciated it. The comments are coming in. Everyone is thanking you. You answered their questions. I think it's very fantastic. And I want to encourage everyone, take advantage of this. Why would you not take a $299 cash flow consultation where a guy like Ross, an expert, an entrepreneurial guru who's been in the business for decades, is going to sit down with you, look at your business, and figure out how to make you more money. Wow. Why would you not take that? So go to that page, smallbusinessaccountantsdurham.com, and fill that in. Thank you, everyone. I want to thank everyone for a phenomenal event. I see more questions coming in, just more thank yous from people. Sharon, no problem. Our pleasure. Michael, yes, you will get a copy of this presentation. And even if you're watching this as a replay, I encourage you, go to smallbusinessaccountantsdurham.com and fill in the information for the free cash flow consultation. This is a huge opportunity. So I want to thank everyone for tuning in. Great health, great wealth.